Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, with oil surging 50% to $100, US waives sanctions on Iranian crude, a high-stakes political move to lower gas prices before midterms. We'll explore how this controversial waiver complicates the global oil market and potentially weakens the long-term power of US economic sanctions. Second Fed Chair Jerome Powell faces a DOJ criminal probe, a move he calls an intimidation tactic in a high-stakes fight for the Fed's independence. We'll examine how this political battle threatens Federal Reserve independence and what it means for global currency stability and interest rate uncertainty. Third, a $55 billion shockwave hits the food industry as GLP-1 drugs rewrite the American diet, forcing giants like PepsiCo to adapt. In this episode, we'll break down this consumer shift's deflationary impact on food prices and what it signals for the Fed's inflation fight. The story begins with a decision that caught everyone by surprise. The Trump administration just temporarily waived sanctions on Iranian oil while being at war with Iran. The White House is essentially trying to perform economic surgery with a very blunt instrument. The core idea is that by releasing this oil from floating storage, basically massive tankers waiting at sea, they can inject more supply into the global market and, in theory, bring down prices. A while back, we talked about the initial shock when the Strait of Hormuz closed, sending oil prices to over $85 a barrel. Well, that situation has escalated dramatically. With prices now surging 50% to over $100 a barrel, the White House is making a high-stakes move to release 140 million barrels of crude. The goal? Bring down prices at home ahead of the November midterm elections. This is a classic case of domestic politics driving foreign policy. The urgency for the administration comes from high gas prices hitting consumers' wallets, a persistent worry reflected in consumer inflation expectation surveys. With the midterms looming, the pressure for action is immense, even if it means dealing with an adversary. But the decision is sending shockwaves through the financial and geopolitical world. A compliance director at Blackstone, David Tannenbaum, told the BBC, to put it mildly, this is bananas. Essentially, we're allowing Iran to sell oil, which could then be used to fund the war effort. Now, this isn't the first time a government has tried to manage markets like this. You might remember the G7's price cap on Russian oil, which was designed to limit Russia's revenue while keeping its oil flowing. The US is now attempting a similar, but much riskier, short-term version with an active adversary. The US Treasury Secretary, Scott Bessent, pushed back on that analysis, stating, in essence, we will be using the Iranian barrels against Tehran to keep the price down as we continue Operation Epic Fury. This is the third time the US has eased sanctions in about 2 weeks, with officials insisting the waiver is limited to oil already in transit and won't fund new production. However, if you zoom out, you'll see another layer of strategy at play. The entire crisis is escalating because Iran has effectively closed the Strait of Hormuz, a vital artery for 20% of the world's oil. Japan, which gets 90% of its oil shipments through that strait, has reportedly begun direct talks with Tehran to allow its vessels passage. And here's where the plan hits a major wall: logistics. Releasing 140 million barrels of oil sounds great, but that oil is mostly on tankers. With the Strait of Hormuz closed, moving, it becomes a nightmare. In fact, tanker rates for shipping crude out of the region have already surged by over 400% this year. Interestingly enough, for our listeners in Asia, one country has been consistently buying Iranian oil despite sanctions. China, nearly 90% of Iran's oil exports have been going to China, often using dark fleets to avoid detection. This US waiver could have an unintended consequence. It might actually reduce the discount China gets on that oil, making its energy imports more expensive. This all begs the question, how desperate is the situation? One energy analyst, Brent Erickson of Obsidian Risk Advisors, believes the administration's efforts won't have a meaningful impact until the strait is reopened. He warns the move raises concerns about the rapid depletion of Washington's economic toolkit. His final take, if we've reached the point of loosening sanctions on the country we're at war with, we're really running out of options. Erickson's point is critical. This move, combined with drawing down the Strategic Petroleum Reserve, signals that the US economic toolkit might be getting depleted. This erodes the long-term power of US sanctions. If adversaries believe sanctions can be waived due to domestic political pressure, their deterrent effect weakens. So what should we watch for next? First, keep an eye on the price of Brent crude oil. Will it fall or will logistical hurdles keep it high? Second, watch the tanker rates in the Persian Gulf. They are a real-time indicator of whether this oil is actually moving. Finally, pay attention to any statements from China about its energy import strategy. In the short term, this move adds tremendous uncertainty to markets. It could put downward pressure on oil stocks if prices fall, but it could also increase geopolitical risk, which is typically bad for general stock markets and could push investors towards safe havens like gold or government bonds. Speaking of high-stakes political moves, the drama isn't just on the world stage. It's also unfolding right in the heart of the US financial system, where the Department of Justice has opened a criminal probe into the head of the Federal Reserve, Jerome Powell. This isn't about interest rates. The probe centers on renovations at the Fed's Washington headquarters. But according to Powell, this is a clear intimidation tactic, a direct shot in a battle over the central bank's independence. For the past year, Powell has been fighting off political pressure to lower interest rates, with the Trump administration openly threatening his position. The core issue here is something economists call anchored inflation expectations. A central bank's greatest asset is its credibility. When people believe the Fed will do what it takes to keep inflation stable, they act accordingly. But if markets think the Fed will cave to political pressure, those expectations can become de-anchored. The fear is that this could force the Fed to become even more aggressive later just to prove it's still in control, increasing the risk of a recession. Now, the conflict has escalated dramatically. In response, Powell is invoking the ghost of one of his most legendary predecessors, Paul Volcker. Volcker was the Fed chair who famously ignored political backlash in the 1980s, raising interest rates to crush inflation. In a recent statement, Powell praised Volcker's willingness to resist, drawing a direct line to his own fight. Now, invoking the ghost of Volcker is powerful, but the economic battleground has changed completely. In the 1980s, inflation was largely driven by goods and wage spirals. Actually, a large part of today's inflation is driven by sticky services, things like housing and healthcare. These prices don't respond as quickly to rate hikes, so applying the Volcker playbook today could inflict a lot of damage on the job market before taming inflation. Powell's words carry the weight of this new conflict. Independence and integrity are inseparable. We need independence to do what is right, and we need integrity to use that independence wisely. And here's where the situation takes a more complex turn. Powell's term as chair is set to end on May 15th. Typically, a chair would resign, but Powell just pledged not to leave his post until the probe is resolved, directly disrupting any plans to replace him. This power struggle creates global shockwaves. Since the Federal Reserve is effectively the world's central bank, the uncertainty reinforces the dollar's dominance, making imports more expensive for Europe and complicating China's efforts to stabilize its own economy. It's a clear example of how US domestic politics can tighten financial conditions for the entire world. The political fallout is already spreading, with a top Republican vowing to block any replacement for Powell while the investigation is open. So with all this drama, what should we actually be watching for? The key is to look past the headlines and focus on the data the Fed cares about. Despite pressure to cut rates, the Fed's true pivot will depend on one thing: a decisive cooling in the labour market. The indicator to watch is the employment cost index, which measures wage growth, a huge driver of that sticky service inflation. Until the Fed sees wage growth slowing to a sustainable level, the bar for cutting interest rates will remain very, very high. This is the real battleground for monetary policy, and it narrows the path to a soft landing for the economy. Powell is framing this as a battle for the soul of the Fed, ending his statement with a line that echoes through the decades. As Paul Volcker showed throughout his career, in the end, our integrity is all we have. We were just talking about the Fed's struggle to control inflation, but a completely unexpected force is now emerging that could actually be pushing prices times down, times in a major sector of the economy. A new class of drugs is quietly rewriting the American diet, and it could wipe out up to $55 billion in annual sales for the food and beverage industry by 2030. Right now, an incredible one in 8 American adults is taking a GLP-1 drug like Ozempic or Zepbound. The shockwave to the market comes from the fact that this isn't just about people eating less. It's about them eating times differently *. Research shows that while users cut calories, they are also actively shifting their shopping carts. For every 100 grams of food they buy, protein purchases actually increase while sugar intake drops. The damage is specific and deep. Snacking has taken the biggest hit, with 70% of users reporting they snack less. Dinner traffic at restaurants has fallen 6% among regular users, and about 45% are drinking less alcohol. Now get this, that 6% drop in restaurant traffic sounds small, but its impact is huge. Surveys show over 60% of GLP-1 users are cutting back on dining out and takeout. This is creating what economists call a deflationary pressure. The drop in demand is so significant it might be pushing down prices in the food away from home category, a key component of the official consumer price index. This structural shift could be masking inflation in other parts of the economy, making it much harder for the Federal Reserve to get a clear picture of what's really going on. This isn't a distant threat, it's a scramble to adapt. PepsiCo is launching protein-packed Doritos. Nestle has rolled out an entire frozen food brand, Vital Pursuit, specifically for GLP-1 users. And believe it or not, this strategy is working even better than expected. Recent data shows 77% of Vital Pursuit sales are coming from households times without times a GLP-1 user, proving the health-conscious trend is spilling over into the general population. Even McDonald's CEO has acknowledged seeing changes in less snacking and less sugary drinks. All this is creating a protein premium in the market. Companies are following the data, seeing consumers on these drugs avoiding sugar and carbs while actively seeking out protein. For a major agricultural trading partner like China, this could reshape US exports, potentially increasing the value of protein-rich crops like soybeans. The trend is only set to accelerate. With pill versions of these drugs hitting the market, JP Morgan estimates over 30 million Americans could be on a GLP-1 treatment by 2030. However, there's a final twist to watch for, the discontinuation wave. These drugs are not easy to stay on. Studies show that over half of all users stop taking them within a year due to side effects or cost. This creates a brand new kind of unpredictability. As millions of consumers cycle on and off these drugs, their shopping habits will swing back and forth, creating massive demand volatility that complicates everything from inventory to earnings forecasts. This isn't a fad, it's a fundamental shift in consumer behavior, forcing a multi-trillion-dollar industry to completely rethink the American plate.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.